Today on Huge Profits, we're going to show you how not to think with your wallet. When you think with your wallet, you're too constrained on what deals you can do. We're going to talk about how you use private money to overcome those limitations.
You know what they say the best kind of money is, right?
Other people's money.
All right, let's get right into it. Look, I've been around you and your investments for years. I knew you when you had no money. I knew you when you had a lot of money.
It's true.
Right? And it's always been mystifying. It's like, well, how do you buy a deal? How do you get off the schneid? How do you get that first deal? How do you get the money to just go and plunk it down and buy a building?
Yeah.
You know, and from what I've learned from you is that private money enables people who might never, ever be able to get into a deal to get into these deals that then launch their career. Is that true?
Oh, it's absolutely true. And in fact, as you may recall, and as so many people have heard the story before, in the first deal that I purchased, I had none of my own money because I didn't have any money to work with. And I wasn't lendable, so I couldn't go to a bank. I didn't have the credit that I needed. I didn't even have the experience or the resume to be able to approach those types of transactions. Mm-hmm. So in the end, if it wasn't for private money and being able to work the friends and family network and close associates and high net worth individuals, there was no chance that I would be able to get a transaction done because I simply didn't have the horsepower to make it happen. And eventually, what I really came to learn and discover, and this is something that I really want to focus on here, it was the deal. It was the way that the transaction or the property would operate that gave me the certainty that I could provide the returns that would be attractive enough to the folks who were easier to borrow from than banks and more readily available with their ability to turn over the capital. That allowed me to close on time with a deal that was time sensitive. It was something that, again, was using creative strategies. And we'll get into some of that where the seller's carrying back 80%. The bank's going to disallow that deal right from the beginning.
Right.
So it allows you to use creative strategies, allows you to get your money faster, and it allows you to overcome, let's say, sponsor limitations that you can't overcome in any other way.
Now, that was your first deal. That's when you're getting started. But you still use private money to this day, and there's a lot of times where it makes a ton of sense still, right?
It always makes sense. I will tell you that here we are 34 years later, and private capital is still the first building block of any transaction that I do. We'll take a look at the building, and we'll take a look at what it can carry and hold on its own, and then we try and start to shave layers off of that, because the further you get away from the maximum debt that it can sustain, the safer your transaction is.
Yeah.
And so as we work through those deals, we start to imagine, well, what sort of capital from a private perspective can the opportunity also support? And you try and find that happy balance between what we're going to use from the seller, what we're going to use from the bank, and what we're going to raise in equity from our private capital. And today, of course, we put money into our deals. It's something that we do, A, because we're capable, and B, because it shows that we've got skin in the game as well, which will then make your investors feel much more comfortable that you also have something at risk and that your bread is buttered on the same side as theirs.
All right, so I think for a lot of people watching, they're going to say, okay, why not just go to a bank? Isn't that the way you buy real estate? You go to the bank, you get a 75% LTV loan, you make your monthly payment, you make sure that it cash flows, and that's it, right? I mean, why private money in general as opposed to traditional financing?
Well, traditional financing is great, but I'll talk about on my first transaction, they were asking questions that I had no clue what they were even asking for. I'd gotten into a situation where it was time for me to take advantage of an interest rate drop. Rates were at 9%, 9.5% actually when I started, and rates had trickled down to the mid-sevens, which by today's standards would be considered even high.
Yeah.
But it was a 2% interest rate drop, which meant huge cash flow advantages for me.
It means huge profits.
Huge profits, right? On the nose. So what ends up happening is I approached the seller and I said, look, we're getting ready to refinance this property. Would you be interested in, a payoff? And they were interested in a payoff, and I negotiated a discount. But what I then did was I said, look, I know you've become, let's say, comfortable with the cash flow that you've been receiving off of this note that I've done for you. And so he was receiving, it was $5,909.15. I remember it like it was yesterday. I paid that man that amount for a little over 4 years. And then we transitioned to a shorter amortization table. So originally I'm paying him over 30 years with a 15-year balloon. And then we moved to a straight 15-year table.
Yeah.
Okay. So when I approached him on that, it was still keeping him engaged, but there was a bank coming in. And it took me 9 months to figure out how to communicate to the bank all of the, let's say, intricate details. And this is going back, again, 30 years, ladies and gentlemen, when banks were far easier to deal with than they are today. And it still took me, almost a year to get ready to go to a bank. The documentation, the paperwork, the scrutiny, the cross-collateralization, the background checks, they're pretty intimidating.
And any loan I've ever gotten, you would assume that the banker is the smartest guy in the room. You'd assume the guy who has the write-off authority to make millions and millions of dollars move, he's got to be a really smart guy. Typically, that's not the case. Typically, they're just following their checklist. They're just going through their institutional things, and that makes banks, number one, rigid, right? They do not understand creative deals.
No.
It makes them slow.
For sure.
Which means you're going to miss out on deals that, look, this deal needs to go now, because whether it's the window for a potential tenant, whether it's because the seller is in the right motivation to sell. So a lot of times, even if you have the great opportunity to get it financed through a bank, the timing doesn't work out.
Well, it's not, the timing certainly is it. And to your point, they're just following their protocols.
Yeah.
They've got a buy box that says, look, if it meets these criteria in here, we're going to lend to you. Mm-hmm. And if it doesn't, as you said, they're very rigid. But it goes even further than that, because they have a creditor's mentality. So from a creditor's mentality, they're taking a look at all of the things that are going to go wrong. They're trying to hedge their bet. So they're reducing the amount that they're going to lend to you through underwriting mechanisms like, they're going to underwrite vacancy that doesn't exist. They're going to ratchet up your operating expenses just to make sure that if they ever have to own the property.
Stress testing, right?
Stress testing. They're going to make sure, that stress testing is typically related to interest rate increases.
Oh, okay.
So if you had a 5% loan and all of a sudden market rates are at 8%, they know you're going to have a huge problem refinancing down the road.
Got it.
So that's typically a stress test. But what you'll also do is in your underwriting, they're going to say fatten up some of the expenses. They're going to assume that you missed out on maybe 10% of your expenses. And so as they do that, they start to chip away at your net operating income, which is...
They're going to assume you're as dumb as they are.
Dumber.
Right.
And they're going to assume that the seller's a liar. So the seller's a liar and you're an idiot and they're the smartest folks in the room.
What a way to live.
And that's fine. It's right. I would say it's a pretty bad view of the world because it's not really true. Mm-hmm. What we're doing is we have an entrepreneurial spirit. They have more of a protect my job and career mindset.
Sure.
So what really holds up banks, what slows them down, is that no one wants to take accountability.
Mm-hmm.
If anybody signs off on that loan, it's their signature on the bottom, and if for some reason the loan either doesn't perform the debt yield, which most people don't even understand, right? That's the return that the bank makes on the money that they lend. That's not the interest rate, it's the debt yield. Mm-hmm. And then if the loan ends up going bad and they end up not achieving some of their ultimate results, then that person's almost certain to lose their job. Mm-hmm. And if you lose your job too many times because of bad underwriting, you don't get another job. And this is what they're trained to do.
Yeah.
So they're really in self-preservation mode. And so that becomes a problem. And there are times, and this is one of the reasons why we like to use brokers. We do use loan brokers because they're able to train you up as you go through the process. So they'll say, look, we submitted it to 5 different lenders. You didn't submit it to 5 lenders. If you submit to 5 lenders, then you're kind of cheating on your girlfriend.
Yep.
Which you don't want to do.
Right.
It's not a good
Banks
look.
don't like it.
Banks don't like it. And so, but when they submit it, they weigh all of the various options and they're trying to sell it. And that's the proper mechanism. Now that individual could get a quarter point of the total loan. They get a full point of the total loan. Some will get more aggressive if it's a bridge loan or if it's a hard money loan because you've got a non-performing asset. But on a standard loan, it's going to be about 1%. So if you're borrowing $1 million, they're going to get a $10,000 fee. Okay,
right.
So not a big deal.
And they're playboys. The banks know that they're
right.
Shopping around.
They're fantastic wingmen.
Yes.
Right. They're going to introduce you to all the options, and then you're going to pick the one that fits best for the situation.
They're the Glenn Brandt Hoovers of the lending world.
They sure are, right? I mean, they're going to be blocking for you like Joe DeLamalure. So in any event, what you got to do is you got to get out there and you got to figure out what your strategy is and know ahead of time. So we line our money up and we try and make it flexible enough that when we find the deal, we can act.
Yep.
Right? So you want to be raising your private money, and we're going to get into how you raise the private money, how you offer it, how you report. So that's all coming. But the idea is you got to have that lined up before you find the deal. In fact, I oftentimes use this cliche, and it's a joke, but looking for private money after you find the deal is like taking Viagra and looking for a date. Okay,
That's pretty good.
The timeline simply doesn't work.
Yeah,
Right? You got 90 minutes to put it together, right? If you got the date lined up, right now you can put it together.
What do I do with this thing?
Right. So the reality is, you've got to start to get people to understand the types of deals you're looking for,
Yeah.
the market, the size, the asset class. So in the beginning for me, hey guys, I'm looking for, small to mid-size apartments, 20 to 50 units in the general greater Cleveland, Ohio marketplace. It's going to be a class B plus vintage, so it's going to be in a great area. It's going to be a little older.
It's your dating profile.
That's exactly what I'm looking for, right? I know what I want. I'm looking for a solid 6.5
Yep.
that we can polish up and turn into a nice 8 plus.
You know,
maybe
take her
9.
glasses off, put her hair down. It's like a 1980s Molly Ringwald movie.
Yeah.
And all of a sudden she's the prom queen.
It's how it happens, right?
It is.
And that's what we do. We find value diamonds in the rough where people otherwise overlook it. Maybe they've left it behind because they sold it short. They didn't really do the investigation or the due diligence. We encourage how that property could be made better.
Yep.
And we figure all of those things out ahead of time. And that's also factored into the private money raise. It's not just what's it going to take to acquire it. Now we've got to figure, well, how long is it going to take to turn this thing around? And in most instances, you can get, if you pick a small, mid-sized transaction, something that isn't completely devoid of performance, right?
Sure.
It's got some tenants. It's not completely been neglected for 50 years. You might be able to get that cheap, but the lift is so extraordinary that the time to turn it around and the risk factors double, triple, and even quadruple.
Yeah.
So you want to find something that you can polish up quickly. We can usually get it done in, let's say, 12 to 24 months is where we can make the biggest dent.
Mm-hmm.
And so you got to factor in the fact that the property won't be performing well. So that's what we call your carry cost.
Yep.
And then you've got your capital improvement cost. So what are we going to do to it? We're going to put on, let's say we're going to put on a new roof. We're going to clean up the kitchen. We're going to, add
Perform an
security
exorcism,
system.
scare out all the vampires, the whole thing.
Well, we've definitely taken on some haunted properties in the past.
I've seen them.
And some stuff in some really rough areas. And what we encourage most of our clients to do these days is to take something that's 60 to 70%, not 6%.
Yeah.
Right? But in the end, it's the cost to acquire, it's the carry cost, it's the capital improvement cost, and then we get into the cost of leasing, the cost of any sort of tenant improvement allowance when you get into pure commercial, retail, office, industrial. Sometimes the tenants will require landlord's proceeds to build the space out to their specifications.
Right.
And you get involved in that. Now that does work out for us because we get more in rent. So that, instead of charging maybe $20 a foot, we might get $30 a foot because we gave them some money, and then that pays us back over a period of time. But when you go to the market to sell it, you get 10 to 20 times each dollar invested back in rent. So that whole construct is the capital stack, and the most important thing and the thing that's going to be the most flexible is the private money that you bring.
Right. So it's kind of like creating some deal flexibility. So, for example, you're buying an auction property.
Yes.
Auction properties. You're going to go to the bank like, I want to go there. Well, how much is it? Well, I don't know yet. I haven't bid. Right. That doesn't work. So, private money is great on auction properties. Yeah. It's also great, I would imagine, and I've seen you use it like this. It's really almost quasi-bridge lending to where you get this property that might not pass underwriting, but you can bring it in that private money, get the deal performing, and then bring in that traditional, debt.
Yeah, that
once it's
takeout debt. Yeah. So that's 100% true. And what will happen is you'll find something, and normally it's the acquisition that gives you the first advantage, right? When you're negotiating on the other side and you're trying to figure out how you're going to build the capital stack and how it works, there's a lot of inflexibility, right? The seller has their absolute needs. Maybe there's loan maturing. Maybe the property is constrained and it's got its zoning and you can't rezone somebody else's property.
Yep.
You can't make any improvements. Maybe there's a huge portion of the property that is not performing. And so once you get control of that property with private money, it gives you the flexibility to start to make the moves necessary. In a lot of instances.
Trim up the brisket, make sure it's all ready to go.
Yeah, a little bit of fat's good, too much fat's bad, right?
Yep.
And so on the property where we're recording, right, we bought this as a defaulted asset from a REIT.
Yeah.
Transamerica had it, our REIT lost it. We were able to buy a $42 million originated note with about $30 million in debt still on the outstanding balance for $4.65 million. So how do you get that, call it, what is that, an 80% discount? Well, we got an 80% discount on the property because it wasn't performing. It was 29% occupied. But
Which
then
no
what-
bank's going to give you lending on.
Well, I mean, you might be able to find an institutional hard capital to do it because I had some lenders that were willing to do it.
That's expensive, though.
It was
Right?
crazy expensive. $640,000 they wanted to close, and they wanted to cross-collateralize with other performing properties. Now, if you don't have other performing properties, now you're already out of the game.
And if you do, you're just risking infecting healthy bodies with unhealthy.
Absolutely, which you never want to do.
Yeah.
So what I did was when we acquired the property, we used private capital to close it, and that really helped. And then I was able to carve off an old Sam's Club. So I had a 165,000 square foot Sam's Club that wasn't performing. And it was on an adjacent parcel, and it was part of the overall sale, but it had its own land parcel. So as soon as I separated that off, I went from 29% occupancy to 78% occupancy.
Yeah, the easiest way to lose 20 pounds is cut off a leg. You know,
That's what they say, right?
Right.
Now, it could hinder mobility, but in this particular
as
instance,
it would.
in this particular instance, it didn't. It actually made us
I
more
bet you my
nimble.
leg weighs more than 20 pounds, though.
There's no doubt.
Yeah.
Which leg are we talking about?
Probably the left one.
Left one?
Yeah.
Okay. There you go. I'm just checking.
Yeah.
So what ends up happening is we're working with the deal. We carve that off. I also started to carve off all the out parcels because it gave me ultimate flexibility. So by segmenting the assets, sometimes that allows you to get creative, and then I could go to a lender. Any lender was going to take this thing when it's 10% away from stabilization versus 60% from stabilization.
Do you know what we call that out by where I live?
What's that?
We call that an Amish mortgage.
Okay.
Because what the Amish folk will do, because I live out towards the countryside.
Yes, you do.
They will buy a 200-acre farm, build a small house on it, live there, then sell that property and cut off that part, and then keep the rest, and then go build a bigger house
Yeah.
with the proceeds from that smaller house, and then they do that 2 or 3 times. They split off the property. Now they have a huge compound, 100 acres, and they just did it by splitting it off piece by piece.
And 17 generations live there usually.
And they have no mortgage on the house. It's paid up, an Amish mortgage.
Three arms, 2 eyeballs because of the inbreeding.
No, the Amish, they live a clean lifestyle.
Yes, they do.
They
Yes,
sure
they
do.
do. I love my Amish.
Yes. So I guess the next part is because I think we've already kind of determined the virtue and how private money can really enable your career, enable your investing power.
Yeah, so those are the whys for sure.
Can I borrow $1.6 million?
What's that?
Can I borrow $1.6 million?
Depends on the deal.
Okay. So the first people that you go to is the people next to you, right? So who do you ask for private money?
Yeah.
And where do you get private money from? Like, do I just walk by and throw flyers in the street? Like, look at this deal, like.
Definitely not.
Oh.
So the Securities and Exchange Commission will take great exception with you if you are out there, let's say, advertising to get people to invest in your projects.
Okay.
Right? They are very strict, extremely rigid. This is not a game. You cannot mess around with it. There's no, hey, invest in my deal on Facebook or Instagram or TikTok. That stuff will land you in extremely hot water with the Securities and Exchange Commission. They will be knocking on your door.
Write that down, everyone watching this.
Yeah, this is not monkey business, and I know we like to get into stuff and we joke about things, but this is serious as a heart attack. What we're talking about is your ability to be able to borrow money, typically from people that you have a relationship with, or let's call it, the 6 degrees of Kevin Bacon, right? So you can get to somebody from somebody from somebody. That still works as far as a warm network, building rapport. So I've worked within, our network for generations now, right? I mean, 34 years is almost 2 full generations raising private capital, but it's a very, very, very tight-knit small network. And that's probably more because I'm a educator and I'm let's say the lead in the room. It's probably a little more sensitive for me to be borrowing money from people that I'm also training.
Sure.
Because what you want to do is you want to show them how the asset's going to perform. So you're going to put together a standard executive summary. And this is something that I have taught tens of thousands of people. It's our, how to raise private money system.
Yep.
And it shows people how to build this executive summary. What's the project? Who are the sponsors? What's the timeline? What is the strategy to make it happen? What's the market? What are the demographics? What about the particular property? What does it need? What are you going to do to make it worth more? What are the risk factors? What's the returns that are being offered? And then you show them your forward-looking statements, which are always done in anticipation. They're not guaranteed. They are anticipated future or forward-looking projections are not a guarantee of returns.
Yep.
You've got your standard disclaimers in there, which you're going to get in any prospectus that you're going to get from anybody raising money. And so those are the things that'll protect you. But it allows you to get your information into people's hands because they're going to tell you, they're interested more often than not, or that they're absolutely not interested in a conversation where you can't follow up.
Yeah.
But if I can leave you something behind and say, look, don't judge too quickly, Ryan. I want you to take a look at this. I think it's a great deal. Here's the information. If you have any further questions, let me know. We're going to be raising over the course of the next 30 to 45 days. We got to close in 60 to 75. I'll need to know if you're in or out, for the most part, within about 2 weeks.
And this would be going to friends, family members,
Yes.
Maybe people you have professional relationships with, or maybe you're at the dentist getting a crown fix. You're like, this dude's probably got money. Like, hey, by the way, like,
Hey, Doc, how's your taxes looking this year? Would
Right?
you like a shelter?
but also like the
Hey,
motivated.
Doc. How your
property. But I think so look, those people who are already inclined to believe in you and know that you have the capability. So friends, family, and close associates. But then also people who are maybe you have a connection with, who are high net worth individuals who are probably looking for
the
passive,
professionals that you work with, right?
passive income, right? They
sure.
they want to get into commercial real estate. They don't want to manage it. They don't want to
can't.
mess with the deal.
They don't have the time.
They don't have the time. But if you can show that, but they probably have financial wherewithal to be able to understand the basics of a deal.
Absolutely, and that's why we keep it simple. We've got our 7 moves to checkmate, which helps anybody understand how it works. You find it, you evaluate it, you make your offer, you fund it, you execute on your strategy. At that point in time, you test the market or you continue to operate with cash flow with good long-term debt. Very simple strategy, and it allows people the latitude to pack into any one of those 7 categories so many, let's say, steps that need to be there, but they really are compartmentalized. And then what it does for folks is it allows them to get their toe in the water with you.
Yeah.
In the beginning, they're not probably going to write you some massive check that funds the entire deal.
Right.
It's going to be a little here, a little there, and you're going to build that capital
And you
stack.
probably a lot of times you'll have to have multiple private investors on a deal like this.
Well,
right?
let's go back to that first deal we talked about,
Sure.
right? So, I didn't have the money, I didn't have the credit, I didn't have the experience, but I had a deal that made sense. And as I was working through that deal, the seller, we paid $918,000 for it. The seller was looking for 20% down. So I personally needed to raise $184,600, which I did not have. And he was going to carry back $734,400. All looking fantastic. In the end, I did all of the things that we're advising the folks who were listening to do. I went to my family. My mother had gotten a recent settlement on a car accident. My brother had a couple of bucks that he had made with a business he had just started, as you well know, and he was doing better. And he's like, look, I'll throw some money in. My sister had a few dollars that she would put in. And then I went to, at the time, my employer, because I was working for somebody, and I had some money in a 401k, but you couldn't really touch that.
Yeah.
And so he lent me the money against that to be able to do it. Now, the story works out is that in the end, he ultimately backed out on me.
Yeah.
So he was going to lend me the money. I thought I had it all lined up. At the last minute, he backs out, which private money will often do. And I'm like, well, then it's not going to happen. I'm going to have to let the deal go away. And I remember my mother calling me up and she said, honey, you're way too close. You've worked so hard for this. Don't give up yet. We can figure this out. And so that's how I was able to bridge the gap. And through friends, family, other associates, and a few high net worth individuals, I raised that $183,600 that I needed, which to me might as well have been $183 million.
Right.
Because I didn't have that either.
Yeah.
Right. So, and I had never seen that kind of money. I didn't have the, let's say, the confidence to ask for that kind of money. But it was the deal that gave me the confidence. They could see that this 24-unit apartment building was made out of bricks. So even if the bad wolf came by, he couldn't blow the damn thing down.
Yep.
Right. And with some, minor cosmetic improvements and some exterior curb appeal, making the place smell a little better because it was starting to get a little stale, and raising the rents, we were able to add value in about 1 year's time. That took it from being worth about $918,000 to almost $1.5 million.
Yeah.
And you were there. We
I
talked
was there.
about that, right?
And then you were able to then go and convert that into, with the substitution of collateral on your original seller. And then you're also able to go to the bank and get that long-term financing, and that launched your career.
It's true. And there was one other little element that we kind of threw in there that was pretty cool. And again, we can't get into it.
By the way, look, we did an entire episode on this first deal right there. Click that link right there, and then you'll be able to see all of it. All right?
Yeah, but what ends up happening is on that first transaction, there were some strategies that we used that, again, we can't get into everything, but I want to get into some of them. On this particular one, we did a post-closing inspection. And so because we weren't able to get through and look at everything, because he wasn't sure that this young kid was going to be able to buy this building, he comes to me and he says, Scott, I've made arrangements for you to see these 2 units. And these 2 units are indicative of the condition of the overall property. Now, were they, or were they maybe the best of the 2 units that he could show me?
Right.
And in the end, that ended up being the case. But I took incredibly detailed notes. And even back in the early 90s, we're taking photos of, the age and the vintage of the refrigerators, and, the condition of the carpet and the paint. And these had been recently redone. So when I went to other units that hadn't been freshened up in 11 years, I had some deficiencies. And I presented to him a deficiency that showed that he owed me 80 grand back.
This is your parlor trick. You're fun at parties with this. What was the exact clause you put into the contract?
Okay. So it said, all of the units which have not been inspected shall be in equal to or better condition than the 2 units represented as typical with respect to age, condition, and cosmetic appearance, or the seller shall make them better or be given a credit to the buyer. Okay?
That's it. I mean,
And we had 2 weeks after closing to submit our final inspection report. How'd I do?
I mean, you are incredibly fun at parties because you can just drop that kind of thing. But that is exactly it. I mean, and I
so that
guarantee
clause
if you
worked
look at that contract, that is verbatim.
It is verbatim. And what ends up happening is we presented in this laundry list of things that were off, and he was a little upset because obviously he'd carried back 80%. Now, out of the $183,000 I've given, he's got to give me 80 grand back. And so, short story was he ended up giving me $50,000 back. I also got a tax credit for the taxes that were due, and I got the first month's rent. So I had $80,000 in my pocket within 2 weeks of closing. And what I did was I went back and I paid off some of my private lenders who expected to be in the deal for more than 2 years, and I gave them full interest as if they had been in it for the full 2 years because I had some of that money available. And I kept a little bit so that I could, A, improve Scott's lifestyle, and then B, we were able to start renovating units.
Yep.
But when I paid them off, and I paid them with full interest for 2 years, and I got it done in about less than 2 months, they were blown away. And then they really wanted to step up when the next deal showed up.
So your private investors will come back multiple deals, right? I mean, it's not one deal and done. I mean, look, you prove it once, they're going to come back time and time again.
I've had some investors who've been with me so long that they flat out aged out. They just couldn't do it they're like, look, I'm not going to be 95 years old next year. Is there any way you can get me paid out? I'm like, yeah, of course.
Yep.
It's been a great couple of decades, hasn't it? And to be honest with you, it's so satisfying and gratifying when you can take people and help their proceeds earn 7, 8, 9, 10, 11% consistently with cash flow after they've retired, because there's nothing out there in the investment world that has that same level of, let's say, durability, right? It's a physical location, it's insurable, it's demonstrable, and you can improve the performance. The stock market's been fantastic, there's no doubt. But the problem there is you have literally zero influence on what goes up or down.
Right. So, a couple things before we wrap up. Now, before we get into the last 2 points that we're going to talk about, if you're watching this, take 1 second, click the like and subscribe button. It's the easiest way to make sure that you're getting every piece of content that Scott puts out. So when a new lesson drops, you'll get notified of that. And, when we look at the analytics, it shows that over 80% of the people watching this statistically right now didn't click that button. Look, and if you're not the kind of person who can click a button to learn more, then maybe making millions of dollars isn't right for you. So demonstrate your commitment to the game, your love of the game, and click the button. For the love of God, just do it. It's super easy. All right. Guilt trip ended. So 2 questions I have before we wrap up, because I think the audience is probably anticipating this. So number 1, when you go to a private lender, are they just going under their bed and pulling out their can of $100 bills? I mean, how do they have to prepare? Because I'm sure they don't always have liquid assets ready to invest in a deal when you got 3 weeks to get it closed. So what does that process look like? How do you guide your lenders into getting liquid to contribute?
Yeah, and what you have to do is you've got to let them know what's coming.
Okay.
And so that's why we say seeding your field, your investor network, by letting them know what type of asset, what marketplace, what size, and what the strategies are. If you're all over the board, hey, we're in Nome, Alaska, and hey, we're down here in Key West, Florida, and hey, we're over here in the Black Hills of South Dakota, that doesn't work, right? People still have a comfort level. And so what you have to do is you have to, as we always say, 2 asset classes. More often than not, people will start with, let's say, in today's market, multifamily or, let's say, small bay industrial properties. That's the most common today. Or they'll deal with, let's say, mobile home parks and self-storage.
Okay.
Historically, what I would have told people to do is multifamily and retail. And those are still great categories by any stretch.
Or mixed use.
Yeah, mixed use is fantastic too.
In a lot of cities, that makes sense. Yeah.
And what you want to do is you want to demonstrate that you have a presence and an ability to go ahead and act and influence the property. You don't have to get on a plane and you have to fly, 5 hours to get there, and you can spend 2 days a month without, necessarily completely disrupting your lifestyle. So once they get comfortable with those sorts of things and you've seated them, now it's time for you to go back and continue to show them, look, this is a deal that we were looking at, but we passed on it. And here's the reason why we passed on it. But we do have 2 others that we're looking at that we think are coming, and now we've got one under contract. When it's under contract, they will have kind of given you...
They got their go bag ready?
Well, they've given you their sizing, right? Yeah. It's like, look, Scott, I'm interested. You can pencil me down for between, let's say, conservatively, maybe $25,000 to $250,000. So I really love it. I can go all the way up to $250,000. But I'm almost certain to be in for $25,000. And you may say, look, the minimum we'll take is 50, right? Because you can't have, if you're raising $1 million, you can't have 40.
Isn't there a limit of how many investors you can even have?
State by state, depending on the way that you do it, absolutely. And we usually try and keep it under 10.
Doesn't that otherwise turn into like a REIT or something like that?
It's called a Regulation D offering once you get outside multiple states and a certain number of folks, and then there's different Reg D offerings.
Avoid that for now, basically.
Yeah, you want to stay completely away from any sort of securities filings.
Yeah, that's what
you want to do. A small friends and family round. Everybody gets their membership units in an LLC. You have an operating agreement that describes exactly what's going to happen. It's very important that you have one final authority. You can't be 50-50. Can't have all chiefs and no Indians. That doesn't work. Yep. And the last thing is you've got to have the ability to break a stalemate. And if you're the one guaranteeing the debt, ultimately the final decision-making authority should reside with you. Yeah. Now, if you've got some whales that are investing in you, they may have guardrails that protect themselves from you making crazy, let's say, poorly informed decisions. But in general, you should be in control. So when you go to those folks, you let them know about what's coming, and they'll give you that range. Then what will happen is you start to line up your commitments, and you always want to overcommit, and the first money gets in, right? It's like, look, the stock's at $30. We know it's going to spike. If you didn't get in at 30, maybe you get in at 40, maybe you don't get in at all, right? And so those people start to make their commitments.
So as more money comes in, can you make the terms more advantageous for you?
Typically not. No. Typically when you make an offering, the offering is what it is. Okay. Now, once you fulfill that raise,
that need,
then you can go ahead and have a second round and a third round, and those things can change.
That's what I was asking.
But typically, I'll say it this way. If it's a global offering, it's typically one standard.
Okay.
However, there are things that we can do that are called accelerants, right? I can give you a more favorable waterfall of capital, meaning that until 50% of your money is given back, you're going to get 80% of the cash flow.
Okay, so this is like a Kevin Leary Shark Tank type deal.
Yeah, you can really carve it up in a lot of ways. We could say you get disproportionate depreciation. You may only have, let's say, $200,000 in it, which may represent 10% of the deal. And if we had, let's say, a $1 million tax shelter available this year, you'd be entitled to $100,000. But we may be able to say, we're going to give you $200,000 in depreciation, your full basis, year one.
And that probably makes sense for high net worth individuals.
Absolutely, because it gives them the ability to defer their taxation and to put that cash to work where they're going to earn another 10, 15, 20% plus the upside on the equity.
Yep.
So you go through those things, and then what you'll do is you'll usually structure it based on a percentage of equity if it's an equity deal. If it's a debt deal, then you want to figure out what that rate will be and what the term will be. Now, as you get into more sophisticated investors, they may ask for points in and out, meaning, hey, if I'm going to lend you $100,000, I want 2 points, or I want a $2,000 fee, so I might only net fund $98,000.
Yep.
Right? But there are other ways of doing that, and so the way that we do it is either disproportionate cash flow, accelerated waterfall of cash flow, advanced and accelerated depreciation. We also have typically buyout clauses. So when I achieve my 15% return, what I'll say is, here's your 15% return at year 3 at refinance. If I meet my test, I gave you your preferred return, which means no matter whether the property works or doesn't work, you're going to make a minimum of 6% on your money. And then we think we're going to hit 15% annualized return overall. If I hit that at year 3, if I've done everything that I'm supposed to do, I can buy out your shares, which means you don't have a permanent life partner in a deal that you want to hold on to for 20 years.
Right.
So you give yourself those types of options and flexibility. And I'll tell you, your private money is pretty much interested in that. They don't want to be in it for 25 years either.
Yeah.
They want to make 15% a year, 12%
Because this is probably
a year.
coming out of either retirement or something of that nature.
Yes, yeah. IRAs, retirement. You want that parked money, the money that people don't have access to.
Right.
And more often than not, if it's an annuity or if it's in an IRA or if it's in some sort of a self-directed investment account, those folks can't touch those dollars personally, but they can lend them to you. And you kind of create these financial partnerships.
If they take it out, they're getting hit with they're getting whacked on taxes.
Yeah, they're getting whacked with all the
But they're
penalties.
probably getting 3% on their whatever, in there.
Yeah, or maybe they feel that the market's too frothy, or they think there's currency risk, or they
Or they
think-
want to take some of it off the table because the market's at a high, so they want to take some of it out of there and to put it into a harder asset.
There is literally no better hedge against inflation than fixed assets.
Right.
And that's what we're talking about here. Commercial real estate's a fixed asset. It can't go anywhere. It's the best hedge against inflation because when things start to become more expensive, then the base value of your building really does help. And so we structure that private money to meet the needs of the individual. And now this is where you can custom tailor it. Right? If it's a global offering in a securities registered situation, everybody gets the same deal. But when you're raising money, yeah, I can give you 6% versus 7% for someone else because, maybe you're going to get 6% because you expect payments every month.
Right.
They'll get a 7% return because they don't need payments until the end.
So you're maybe putting a few different flavors of the same offer.
Absolutely, right? You can put salt on it. You don't have to put salt on it.
Got it. So let me ask this. Now, I know you're... Nope, not slimy. So you're not a lawyer, but what type of entity typically do you use in these type of deals, right? Because you're talking about things like pass-throughs and debt and depreciation. What do you use?
I mean, traditionally when people get started, we use all kinds of mechanisms at this stage,
right.
relatively sophisticated, relatively diverse. Some deals have a lot of partners, some deals only have some. So we've done some Reg D offerings, we've done some other stuff. But when people get started, what we typically tell them to do is you want to work with a single asset LLC. So you don't put everything under one global umbrella. That tends to put all of the risk together. If all of your apples are in one barrel, one bad apple spoils the whole bunch.
Right.
If you've got them, individually wrapped and they're separate cooling systems, now what ends up happening is if something goes wrong over here, everything else is compartmentalized. The LLC also allows you to have pass-through taxation. So your gains and everything flow through to your personal tax return, and it gives you maximum advantage to take the opportunities for depreciation and offset some of your gains.
Right.
And since you are going to likely be a professional real estate investor developer, any losses that you have from your properties, whether they're paper losses or whether they're active losses, like the property didn't make money this year. Okay, well, that's an active loss.
Yeah.
A passive loss is, well, the property made $500,000, but we've got $10 million in it and we've got $1 million in depreciation. You don't pay any tax on that money.
Right.
And so by utilizing that LLC,
But there's only so much of that loss you can claim in a year too, right?
Yeah, there are limits, but
that's what you can then use to incentivize investors and
absolutely, we
Right.
share the wealth on that
That's right.
shelter. And then there is recapture later, depending on how it goes. You ultimately have to pay usually 25% of that back to the IRS when you cash out.
Yep.
So if I got $1 million in tax shelter, I'm going to have a $250,000 recapture down the road, unless I do yet another deal.
Right.
Or you can do a 1031 exchange, which are a little more complicated. We don't usually advise people to do that. We usually say pay your taxes when they're due. If you don't want to pay Uncle Sam now, you're sure as heck not going to want to pay him
When it's bigger.
when the number's 10 times that size and you don't have the same career trajectory.
Yep.
So those are the things that we tell people that you want to do. And then you really want to get your terms down specifically. You want to know exactly what they're looking at. Now, time frames are flexible. They have to be. You can't say, look, you definitely are going to get out of here in 12 months. You want to be a little bit flexible with your private money, but there is a limit to how far you can go. So, in our bigger deals, it could be as much as 7 or 10 years. And we want a 10-year hold because with an opportunity zone, if you held it for 10 years, at the end of that 10 years, there's zero capital gains tax. So that's a big win. But some of the deals are, more velocity based. It's the velocity of capital that helps you win. You bought it for, let's say, $500,000. You increase the value to $1.5 million. You got $300,000 in improvements. It's a $700,000 gain. You're 60% of it because of the way you raised the money. You made $420,000 and you got it done in under 12 months.
Right.
And that's something that can work for a lot of folks. And that's where those depreciation tables come in. So
Yeah, that way you can
timelines.
get somebody out of a deal earlier. But let's say, hey, look, you plan on being in for 5 years. But then when you get them out in 2 years,
They're happy.
they're very happy.
As long as you can redeploy the capital. Because a lot of times, like, look, I like my 10%, 12% annual yield. I don't want the money back. I don't need it.
Okay, but you could either keep them in,
Yes.
or, well, then let's look at another deal.
Let's look at another deal.
Right, so-
or we can just turn you into private capital. We don't have a deal specifically to place you in right now, but you can go into our lending pool. And we'll continue for the next 12 months to give you the returns that you've been getting now. And if we can deploy the capital, then we will. If we can't deploy it, you're going to get 1 more year on this. And if at the end of that year we've not found a suitable investment that we both agree on, then we'll return your capital to you.
Nice.
So we give them that kind of echo benefit
Yep.
in a lot of instances. And that's something that I don't really know that there are many other people who do.
Yeah.
Right? Because we don't do it in a formalized fund. Right?
Right.
So if you get into a fund where you raise the money before you know what you're buying, you're giving a return whether you're using the capital or not. And that's typically not a good idea unless you have great
makes
deal
me,
flow.
That makes me squirm. So one thing, now, look, if you're interested in learning, if you're watching or listening to this, if you're interested in learning the details of this and really getting in the nitty gritty, wow, the nitty gritty. Wow, my tongue just got real fat there.
That's all right. Happens.
This is great because I'm trying to do a sales pitch for you.
I
No,
appreciate you.
this is all on Commercial Hub. So Scott's got this platform, it's Commercial Hub. It has all of his lessons, all of his courses, all the things that he's taught over really 25 years now into one platform. You can go and watch the videos. They're all in different broken up lessons, so you can go back and find the things you're trying to look for. It has all sorts of great other features, tons of different courses. It has the full evaluation tool. It has the ability to pull reports so that you can get market analytics. It's got so many things. Go check it out. Go to commercialacademy.com or commercialhub.com.
Well, it's also got the How to Raise Private Money course,
that's
which we
exactly
talked about,
it.
which really, it directly correlates to what we're talking about here. It gives you a step-by-step approach. It's kind of like a pamphlet.
Yeah.
It walks through really, really simply.
It gives you the nitty gritty.
And so then with that, what it allows you to do is allows you to follow that template, plug your deal into it, and in the end,
It has the deal prospectus. It has the you have the documents, some of the management documents you can give to your lawyer so that you can fund or structure your own deal.
absolutely. And it talks about, again, the deal, the sponsors, the capital, the timeline, the risk, the opportunity, what we're going to do to it, what's our execution strategy, and finally those forward-looking statements. So it gives you the things that everybody needs, but you're doing it in, let's say, a friends and family sort of environment where you're not getting out to regulators. And that's really going to be the key, because if you have to do a Reg D offering, it's $25,000 to $50,000 to put something like that together. There are filing fees for every state that someone else comes from.
Accredited investors.
Accredited investor test, so they have to have suitability questionnaires and all of those things. So this will save you a ton of time. This has been a great one. I really have enjoyed this. And I'll tell you what, in my experience, if you can't get the private money piece right, so many people struggle and grapple with getting off the mat and getting started. If you'll take this to heart and you'll start to talk to people about things instead of having those random conversations. Hey, how you doing? Oh, I'm fine. How are you? Did you see the football team this weekend? No. What are you up to? Well, looking at some investments. Oh, really? What are they? Talk about what you're doing. People are curious, and as soon as they see you, starting to look to improve your lifestyle, they're going to want to benefit from that too. They may say no a couple of times, but if you stick to it, if you give them good information, if you show them how you are succeeding and how you are following through, eventually they will join your team with private money. I've done it over 34 years. You can do this too. It's really not that hard. It just takes the confidence to know that the deal that you're promoting is one that you believe in. And if you do that, then the rest of it usually handles itself.
Well, yeah, really great episode. I think you shared a ton here. If you want to learn more, go to commercialacademy.com. You can get access to Commercial Hub. You can go to one of his live events, or you can join one of his private investment training groups, and you can learn exactly from him how he does this and everything else to make you successful in commercial real estate and in your investments. Great episode.
Thanks so much, man. We'll see you next time. God bless.